All right, welcome to The Explainer. Today, we're pulling back the curtain on the framework high earners use to strategically and totally legally slash their tax burden. You know, for so many people, taxes end up being their single biggest expense over a lifetime. I mean, with federal and state taxes combined, you could be looking at rates over 50%. It's a progressive system, right? The more you make, the bigger the percentage they take. So the question is that just a fact of life? Well, experts say the real solution isn't about hunting for a few extra deductions here and there. Nope. It's about completely changing the kind of income you make. Okay, let's really dive into what that means. So here's the core idea. It's all about shifting away from earned income, the money you get from your job or an active business, because that stuff gets taxed to death. The goal is to move towards portfolio income, which comes from your investments. And this one idea, it shows you the huge difference in how the tax code treats working for your money versus having your money work for you. This is exactly why the wealthiest people focus so hard on portfolio income. Okay, so let's get into the foundation. It all starts with creating legal entities. This isn't just about making money, it's about building a fortress around it to protect it and make it work smarter. The very first building block you're going to want is usually a limited liability company or an LLC. The easiest way to think about it is like a legal shield. It creates a wall between your business and your personal life. So if, God forbid, your business gets sued, your personal stuff, like your house, is safe. And just as important, it helps you sidestep what's called double taxation, because the profits can just pass through directly to you and get taxed at your personal rate. Super efficient. Now, to organize this whole fortress, experts have this really cool mental model they call the T formation chart. It gives you a clean visual for your entire financial world. The base of the T is your trust. That's for your long-term estate planning. Then one arm of the T holds all your active businesses. The other arm holds your passive stuff, the assets that generate income without you having to be there every day. It's basically a map. And now we're going to start placing different specialized LLCs onto that map. So let's start filling in that T formation map, right? This is where you see that not all LLCs are the same. They have very specific jobs. You might have a holding company on one side of the T to own and protect passive assets, like real estate. Then on the other side, an operational LLC is running your day-to-day business. And then you get into specialized tax structures, like an S-Corporation, which can literally save you a fortune in self-employment taxes. You can see how each one is like a different tool in the toolbox, designed to solve a very specific problem, whether that's liability, privacy, or just being way more tax efficient. Okay, you've got the structure in place. Now it's time to add the fuel. And the most powerful engine identified in this whole analysis is, without a doubt, real estate. The tax code gives more incentives and benefits for real estate than for almost any other kind of investment.
And this is the key to the whole thing. You have to understand why. The government can't build houses for everyone, right? So it gives massive rewards to private investors who do. And the biggest, most significant reward of them all is something called depreciation.
Okay, so what is depreciation? It's an annual tax deduction that lets you write off the cost of a building, not the land, just the building, over its useful life. For a residential property, that's 27 and a half years. But here's the wild part. It's a non-cash expense. It's often called a paper loss because it lowers your taxable income even while your property is very likely going up in value. You're basically getting a tax deduction for wear and tear, but you're not actually spending a dime. So having a big paper loss from depreciation is amazing. But there's a catch. There's a huge hurdle that stops most high earners from actually using that loss to offset their main income. So let's break down that hurdle and then talk about the specific loopholes you can use to jump right over it. So this hurdle, it was put in place back in 1986. They're called the Passive Activity Loss Rules, or PAL rules. And what they say is you generally can't use losses from a passive activity, and most rental real estate counts as passive, to cancel out income from your active life, like your W-2 job. This rule right here is the wall that stops most people cold. But for pretty much every rule in the tax code, there's an exception. And there are two really big ones here that let you reclassify your real estate losses as active. Once you do that, you can use them against your main income. The first path is becoming a real estate professional, or reps. But that's a huge commitment. We're talking over 750 hours a year. The second path, which is way more accessible for most people, is the short-term rental, or STR, loophole. The time commitment there is much lower.
All right, so once you've unlocked those losses, how do you make them as big as possible? You use a strategy called a cost segregation study. This is pretty cool. You hire an engineering firm, and they literally break down your property into all its little pieces. The carpets, the light fixtures, the appliances, everything. And they separate them from the actual building structure. Why? Because all that stuff can be depreciated way faster, over say 5 or 7 years instead of that long 27.5. So let's put some real numbers on this, because this is where it all clicks. You do a cost segregation study on a single $500,000 property. That can easily generate a massive first-year paper loss of around $125,000. Now here's the magic. You combine that huge loss with the STR loophole, which remember has a much lower barrier to entry, and that entire loss can now directly wipe out an equal amount of your high-tax W-2 income. It's a dollar-for-dollar reduction of your taxable income. It's huge. So all of this, the structure, the real estate, the loopholes, it all leads to the ultimate strategy. This is the long-term plan for living off tax-free wealth, the one the ultra-wealthy use to build and transfer fortunes across generations. It's a 3-step process, and it sounds simple, but its power is just immense. First, you buy assets that go up in value, like all that real estate we just talked about. Second, and this is key, instead of selling those assets and getting hit with a monster tax bill, you borrow against the equity you've built up. A loan doesn't count as income, so the cash you pull out is completely tax-free. You can literally live on this money. And finally, the end game. When you die, your heirs get the assets at what's called a stepped-up basis. This rule is critical. It means the cost basis of the asset resets to whatever it's worth on the day you die. So that entire lifetime of capital gains, poof, it's gone, wiped totally clean for the next generation. The most important thing to take away from all this is that these aren't just a bunch of isolated tricks. They all fit together into one integrated system. Building that LLC fortress, using real estate as your engine, unlocking the losses with the STR loophole, and then playing the long game with buy, borrow, die. It all works together. Of course, this takes super careful planning, professional help, and most importantly, you have to keep rigorous documentation of everything you do. At the end of the day, the analysis really shows that it's about taking a proactive, architectural approach to your finances. Instead of just reacting to them, it's about designing and building a machine that works for you, not just earning a paycheck. Thanks for joining us for this explainer.